Gold is often described as a timeless safe haven. Commentators point to inflation, currency devaluation, and geopolitical uncertainty as reasons for its profound bull market right now. This is the familiar narrative that is told to the public, but it misses the deeper truth. Gold's price is not being driven primarily by households or small investors. It is being shaped by large institutions, governments and corporations that are capturing the supply and remaking its role in global finance. The key development making this capture possible and acceptable is tokenization. Gold is no longer just a physical commodity stored in vaults. It is being turned into a programmable, fractional and tradable asset that fits neatly into the emerging digital financial system. That shift changes everything about how gold functions and why its demand is accelerating. As we all know, central banks have steadily increased their gold reserves to apparently insulate themselves against systemic shocks and expect to buy more in time. Clearly, this is not speculative buying, but a deliberate strategy. And one clear consequence is that their hoarding creates scarcity. The accumulation is concentrated, leaving less available for ordinary investors, which reinforces and centralizes institutional control. As the tokenized gold market matures, it will amplify this effect. By creating digital claims that represent physical holdings, central banks and authorized institutions can circulate gold within regulated frameworks without relinquishing custody. Tokenization makes gold a system-compatible asset. Governments can track ownership, enforce compliance, and embed the metal into financial infrastructure. It is no longer just a passive reserve, but a programmable tool of monetary and regulatory power. Corporations are leveraging tokenization to extract value while consolidating control. Tether provides a recent clear example. Alongside more than 100,000 Bitcoin, Tether now holds roughly $8.7 billion in physical gold reserves. These reserves back its tokenized gold product, XAUT, which has a market capitalization above $1.3 billion and ranks among the top 100 crypto assets. Tether is not only holding gold, it is actively shaping the tokenized market. By controlling issuance, governance and trading, it ensures that public access is mediated and profitable for the corporation. Tokenized gold is structured so households hold digital claims rather than physical metal. Of course, it has its benefits for users, but the benefits largely accrue to the custodian. Redemption can be limited, custody remains centralized, and value flows to corporate actors through fees, transaction spreads, and control of liquidity. This creates a market illusion. Retail investors see rising token prices, which will increase liquidity and participation, which will likely support price. But they are interacting with abstractions rather than the core asset itself. Volatility and operational risk are transferred to them, while the meta state, that is the supranational organizations and corporations, are keenly outsourcing risk, as we discussed here. They retain control. This creates extraction without force. Ordinary participants believe they are gaining access to a safe asset, while the corporation simultaneously benefits from platform control and market design. The public participates in a rising gold price without ever truly owning the physical core. Gold is more than a financial asset. It carries symbolic weight as wealth, stability, and trust. By controlling both the physical reserves and tokenized claims, institutions and corporations anchor cultural beliefs while structuring behavior. As central banks hoard to build a foundational bedrock, they send a signal to the marketplace. People naturally associate safety, value, and legitimacy with gold while simultaneously participating in a system designed to protect the core and distribute risk outwards. This is about survival. These powerful institutions treat gold as a reserve to shield their financial core from the volatility and shocks of the wider global economy, even if they're causing them. Every ounce removed from circulation reduces exposure for these institutions while leaving price fluctuations and risk for the periphery. Gold is rising because it is being hoarded and protected. Retail demand is secondary. The key swing factor is central bank buying. This control is subtle but powerful. It shapes expectations, investment habits, and attitudes towards money, even among those who consider themselves awake. As tokenization and retail participation grow, new participants feel autonomous, but their decisions occur within a framework where choices can be constrained by platforms, regulations, and coded rules. Central banks and other institutions leverage human psychology, turning belief into a mechanism of system stability. This playbook is far from being isolated to modern times. Indeed, silver mines were monopolized in ancient Mesopotamia in the 2nd millennium BC to ensure monopolization of the money supply. More recently, Peter Miller provided an analysis of the 20th century monetary trends in his 2006 analysis, showing that gold's value has historically surpassed that of other assets, positioning it as a cornerstone in times of monetary instability. Miller underscores the necessity of gold in maintaining the stability of the world monetary base, particularly when faced with excessive debt burdens and inflationary pressures. Indeed, Miller breaks this down into 5 clear stages. Phase 1, stability. Phase 2, inflation. Phase 3, disinflation. 4, instability. And finally, phase 5, monetary reform, enabled by a potential revaluation of gold to overcome deflationary debt depression. Despite growing consolidation and the behavioural conditioning built into tokenized gold, there is still a hopeful side. Gold was one of the first ways humans abstracted real wealth. It showed that value could exist beyond immediate use, that it could be stored, preserved and exchanged. That truth still holds. Even as institutions tighten controls and markets filter access, people can increasingly see the reality behind the system and act with awareness. Understanding tokenization, the divide between central banks and the people themselves, and the symbolic role of gold gives individuals the power to make conscious choices. Simply recognizing how the system works is already a form of autonomy. Gold's abstraction reminds us that wealth can be preserved across time, but it also reveals the difference between representation and reality. Central banks may treat gold as the altar of value, the reserve that underwrites their financial alchemy. But for individuals, gold is better understood as armor, a form of protection against monetary instability, not an altar and the source of meaning itself. Real wealth comes from autonomy, relationships, knowledge, and true resilience. Gold can help defend these things, but it cannot replace them. The hopeful truth is that by seeing through the system's use of gold as a tool of control, people can use it strategically without mistaking it for the essence of real value. So a small percentage of gold's rise is in response to inflation hedging. But the primary determinant is that the world's financial core is securing itself from its inflationary policies while transferring risk outwards. Tokenization strengthens this strategy by creating liquidity and the appearance of participation, while leaving ultimate control with central banks and corporate actors. Psychological and cultural forces ensure that the population accepts the system and engages with it willingly. If we want to remain with some degree of independence, it has to come from owning your wealth and making smart choices. Power comes from seeing how the system works and acting upon it. Now, thanks so much for joining me. I hope this has been useful information, and I look forward to seeing you next time. Bye bye.